This is Matthew Cratter from Trader University, and today I want to talk about the Apple stock split and how you can profit from it, and in general how stock splits work. If you're interested in learning how to make money in both bull and bear markets, or you just want to see trading strategies that work or see what I'm investing in or trading, be sure to hit that subscribe button. So we got an announcement last Thursday after the market closed that Apple was going to be doing a 4-for-1 stock split. And what this means is that when they do it, every shareholder will receive 3 additional shares for every share that they are holding. Now, Apple has done this in the past. They did a stock split. They did actually a 7-for-1 stock split on June 9th, 2014. They did another one in 2005, 2000, and 1987. So what exactly is a stock split? Well, basically, stock is just ownership in a company. That's why they're called equities. Equity means ownership. So if we have the apple pie here, let's say this is total ownership in the Apple company. This is total ownership. It's divided into different slices. Each of these slices is a share of stock. And if you add all the slices together, you get the value of the entire pie, which right now is obviously close to $2 trillion. But what a stock split does is it really just says, let's make more slices of pie. It's not really going to change the size of the pie necessarily, but what we're going to do is we're going to make the slices more thin, and we're also going to make them each have a lower value. And so as a result, they're still going to add up to the same pie. This is still going to be equal to 100% ownership in the stock, but each individual piece is going to trade at a lower stock price, and they're going to be more slices of the pie. So let me just show you how that calculation works really quickly. This is important to understand if you're going to know how to profit from these. So if we just go to Yahoo Finance, we go under statistics here, and we scroll down. This is a good place to find the number of shares outstanding. It's listed right here, 4.28 billion. We're going to do something, we're going to do it a little more precise. So what we do in that case is we go to the 10Q, excuse me, you just Google 10Q Apple. This is the most recent one, dated July 17th, 2020. And if you just scroll, it's usually at the bottom of the first page or just right at the close to the top of the second page. We can see here that there are 4.275634 billion shares of stock as of July 17th. So the number we were getting from Apple here is they just rounding it up. But I wanted to use a little more precise numbers. So basically, currently, this number of billion shares outstanding, 4.27 something billion shares outstanding. The stock price is trading today at around $439 a share. So if we want to calculate the valuation of the company, the market cap, the total value of equity, in other words, how much money you would need if you wanted to completely buy Apple stock and take over, buy every single share, we would just take the current stock price times the number of shares outstanding, and that will give you the value of the whole pie. Basically, we're taking the price of each of these little slices, the number of slices, we're multiplying them, and so we just take 4.27 billion essentially times $439 a share, gives us a market cap of 1.877 trillion. So we're talking about one of the largest companies in the world, probably is still the largest, on its way to a 2 trillion market cap. And when people talk about how large a company is, they're usually referring to market cap. So what's going to happen after the stock split? Well, instead of there being 4.27 billion shares, they're going to divide each of those shares. And so there's going to be 4 times as many shares. There's going to be 17.10 something billion shares. Basically just the number of shares before times 4. And then what they're going to do on that day when they do the split, which I think they said was August 31st, it'll begin trading then. They're gonna cut the stock price in divided by 4. So instead of wherever it's trading on that day, it's going to be roughly if it's trading at 439 as it is today, they'll divide it by 4, and it will be trading at 109.75. So basically, if you take 4 times as many shares and 1/4 of the price, I think you can see you end up with the same market cap. It's not going to change the value of the total market cap or valuation of the company. But what's strange about it, so this would be in a rational world where people were rational investors. Basically, you have the same pie, you still have ownership in the company. Maybe the company is going to do better, maybe it's going to do worse, but just changing the number of slices shouldn't really be doing anything. But in the real world, it would appear to do something. So we can see here on this chart, this was right here was when the market closed. Apple had a blowout earnings announcement. They announced the 4-for-1 stock split, which is not going to take place until the end of August. So again, it's very important to distinguish between the announcement date and the actual stock split. But we can see that the stock gapped up and finished up about 10% last Friday on July 31st. So the market saw this as very good news. And I want to go into briefly why it saw it as very good news. So the first piece is this is a stock that's trading at all-time new highs, 52-week highs. It gaps up on good news. And so the first thing at play here really is something called post-earnings announcement drift, where when a stock makes a big move on new information, like new really good, really bullish earnings, good forecast for revenue growth, etc., the stock will often make a move on higher than normal volume. It will gap up as people who are short the stock have to buy to cover their shares, and as institutions that are underweight the stock begin to add more shares and to incorporate the new information that's been revealed by earnings. So this is why stocks that report post-earnings announcement drift, that have a good earnings report, will tend to drift for anywhere from a couple days to a couple weeks as institutions rebalance. Normally this doesn't work as well for really large cap stocks or mega cap stocks like Apple, but it seems to be working quite well. So that's the first thing we have. We have a stock that's hitting new highs, those are the kind of stocks that tend to have continuation moves. We have a stock that's benefiting from post-earnings announcement drift, gapping up on really high volume. So that's the first piece. But then you have the signaling value of the 4-for-1 stock split. So let's look at what happened back in 2014. So on April 23rd, 2014, Apple announced a 7-for-1 stock split. This was the announcement date, April 23rd. The actual split was to happen on June 2nd. So just a month and a half, roughly a month and a half later. That's when the actual split would happen. So if we look at a chart of when this happened, we can see that the stock gaps up. The news was reported after the market closed here. The next day, the stock gaps up. It's obviously trading up in the after hours as well. And you get a similar move. You get post-earnings announcement drift, and you get the signaling value, which we're going to talk about, of the fact that they're going to do a stock split. And when a company decides to do a stock split, they do this because management thinks that company prospects are very good looking forward. So here was the announcement after hours. We had the initial gap up, and then the actual date when the stock split happened, June 2nd, 2014, was right here. So this is a classic case of sort of buy the rumor, sell the news. So you buy here, and then you sell here. Now, obviously, a lot will depend on the overall market, whether the stock continues to drift higher or not. But you basically captured the bulk of the move if you bought on the announcement and sold maybe a couple days before the actual split happened. And this is what often happens, is that new information gets incorporated fairly quickly. Now, if we scroll out, we can see that Apple continued to appreciate. Maybe this was because the stock market continued to go up, etc. Of course, Apple is a big driving part of the stock market indices. But we can see here that stock splits do have a tendency to convey new information. And so then the question is, how quickly does that new information get baked in? So when you have a 10% gap up, that's obviously quite aggressive. On the other hand, we're in kind of a bubbly, crazy time. So I could definitely see this running, continuing to run until a couple days before the actual stock split on, what did we say it was? August 31st. Now, there are a couple papers I'll link to that talk about the signaling value of stock splits. So the basic idea is that managers will never do a stock split, especially for a high-priced stock, if they think the company's about to do badly over the next 3 or 6 months. Because what will happen if they do a stock split, there's a chance that the stock price could go down further, and this just looks bad if you do a stock split. And if the stock does badly enough, it could enter the single digits. It could start looking like a penny stock. Obviously, this is not going to happen to Apple. It's already going to have a stock price probably above 100. But what the market has figured out, so the basic level of understanding the sort of flat-footed level of understanding is stock splits should not change anything because you're just slicing up the pie into more pieces. But then sort of the next level of understanding is that management only does stock splits when they think there is going to be good news coming. So, for example, in this article, only managers with favorable private information use stock splits to signal. And I'll link to this paper, Behavior Signaling Explanation for Stock Splits. This is actually evidence from China. You can see this similar effects happening in stock markets all around the world. Here's another one from 2019, Stock Splits, a Reevaluation by Gary Smith. And the more compelling argument is that corporate stock splits, I'm quoting from the abstract, signal a board's confidence in the company's prospect. So the basic idea here is that no one knows what's going on at a company better than the management team and the board. And so if they're willing to do a stock split, it is a sign that they're quite bullish. And obviously this is how the market interpreted it. It began to immediately price in good news into the stock. And then we've had a bit of a run. Again, these things, the stock doesn't have to continue to run until the stock split. But when you're in a bubbly market like this with a good uptrend, there is a strong tendency. So you'll have to decide for yourselves. None of this is investment advice, obviously. Does sort of the post earnings announcement drift and the signaling value here of the stock split overwhelm the fact that August is traditionally sort of a weak month for the markets? There can be volatility, etc. On the other hand, we're hitting new highs here in a lot of stocks and indices in August, so it's hard to tell whether it's going to be that kind of year. But just wanted to make you aware of the fact that in the markets, there's always sort of the base grok level of a stock split shouldn't change anything, but then there's the more sophisticated level where the market has learned to read things like stock splits as signaling mechanisms from management or from the board. If you found this video helpful, be sure to hit that subscribe and like button. Hit that bell so you'll be notified when my next video comes out. And let me know your questions and comments in the comment section below, and whether you're going to be buying Apple. If so, why? If not, why not? Thanks a lot for listening, and I'll see you in the next video.